And if you look at JP Morgan and Goldman Sachs and Citigroup, they can't issue stablecoin. Now, if you roll the clock back 6 months, the president's working group put out a memo on stablecoins. And when they put out the memo, they said, we'd like for FDIC institutions to issue stablecoin. Now, putting aside whether you agree with that or not, there's been a regulatory deadlock on Capitol Hill, because in the 6 months after they put out that memo saying they think that banks should issue stablecoins, no bank issued a stablecoin. And that's because the president's working group memo said, well, Congress should pass the law making this clear. And until then, we'll think of it this way. So the banks are waiting for Congress to pass the law. Congress didn't pass the law. And all the way up until last month, there's really no clear consensus to move on this. And we didn't expect any clear legislation or regulation before 2023 or 2024. So I think that if we just take the example of stable coins, that crypto crash and the UST crash has simultaneously educated the existing crypto market and all the investors. It's also introduced, the concept of risk. There are different, not everything is equal, right? There are 19,500 things, on coin market cap, but the anarchist, I hate regulators. I don't want them to do anything. Well, that's one way to view it. But as long as they don't do anything, the industry stays $1 trillion, $1, $2, $3 trillion. When they do something, then you're going to see people like, let's say David Solomon was on CNBC last week. He's the CEO of Goldman Sachs. Well, whatever Goldman Sachs thinks is probably what JP Morgan thinks and Citigroup thinks and Bank of America thinks and Wells Fargo thinks. So what he says is, yeah, we know the crypto economy's here to stay. We can't custody it yet. We're afraid to custody these assets. Like we're not allowed, his actual words were, we're not allowed to.
Right.
And if I speak to CEOs of publicly traded companies and banks, like publicly traded banks, they'll say, our regulators won't let us. So you see the conundrum here, which is you could either stay in a regulatory gray zone where there's about 1% of the money and there's someone that can make decisions. And if I can actually make decisions, if I can take $3 billion and buy Bitcoin, and then I can take the same Bitcoin and sell it on behalf of the people that own the Luna token or on behalf of the people that own the UST token, I'm acting, kind of like a public company officer, like, and if you're a public company, like think about MicroStrategy. Like if I just sold all of MicroStrategy's Bitcoin and I didn't tell you, right? Or if I bought twice as much and I didn't tell you, I would be changing the nature of the security. I have, kind of an obligation to disclose that, an ethical obligation as well as a legal obligation to disclose what I'm doing when I can actually impact the value of the securities held by the public. So I think that this is going to accelerate that regulation. It'll accelerate the regulation of the crypto securities, and which are many of them are unregistered securities, and there's no disclosure. And every day, ETFs publish their holdings. If you own it, and there's thousands of ETFs. ETFs are kind of like they're derivative securities of sorts. So, if I can buy an ETF and every day they tell me what their holdings are, then I can get comfortable trading it, shorting it, going long it, holding it, et cetera. So his view was, why can't we see the same disclosure on something like a stable coin, right? We should get some periodic disclosure. And then he ended his discussion with kind of like a degree of frustration, like it's overdue, like it's time to stop screwing around. And if we have regulatory clarity, it's going to open the way for tier one firms like his own, like Citadel. But what he really means is Goldman Sachs, JP Morgan, Citigroup, Bank of America, Wells Fargo, Citadel, all of Wall Street. It'll open the way for them to make markets, do research, right? And to provide liquidity. And provide liquidity eventually means loans and as well as hold on their balance sheets. So there's a debate going on throughout the world. And I think that the answer to what would I trust depends on who I am. if you ask the question, what will a big publicly traded company trust? A publicly traded company would trust a stablecoin issued by an FDIC insured bank. So, for example, MicroStrategy is not going to hold either Circle or Tether or DAI or a UST type thing on its balance sheet, because none of those meet the standard of an FDIC insured bank. And from our point of view, all we're wanting to do is move money from point A to point B with no risk. And so there can't be more risk than having the money in a Bank of America or Goldman Sachs. Now, if you look at other players, right? If you're a private company offshore, if you're a company in Venezuela or Argentina or Lebanon, then would you take the FDIC stablecoin? Sure, you would. But you might also take a public company like Circle. No. For example, if you'd asked the same question to Jeff Bezos in 2003 and said, you just had an 80% loss in Amazon. Do you ever wish you sold Amazon in the year 2001?
Yeah.
Jeff Bezos could have sold Amazon in the year 2000 and avoided a 95% loss. Do you wish he did?
That's true.
But you see how foolish that is, right? For example, Mark Zuckerberg, could have also sold Facebook, just before or just after the IPO and avoided a 50% loss. And, in fact, Jeff Bezos could have sold Amazon 5 different times and avoided an 80% loss. And if he'd sold at any one of those 5 times, he wouldn't be one of the richest people in the world. So I think that that trying to time the market is a trader mentality. But if you look at all the richest people in the world, they're not traders, right?
They're hodlers.
Bill Gates, Steve Ballmer, Jeff Bezos, Elon Musk, Mark Zuckerberg, right? Larry Page. Name the person that traded their way to that situation. You can't really do it. Like trying to time the market is ridiculous. If you look at statistical analysis of Bitcoin or the S&P, I think the conclusion generally is that like 80% of your returns come in like 1% of the days. It barely crawled forward, but it didn't actually keep up with inflation. The S&P is up 29%. So if you bought pretty much all of the desirable companies in the index, it didn't actually hedge your inflation. It lagged inflation. And why? Because you're owning securities and the corporate management teams have inefficiencies. They're basically an overhead cost. Bitcoin's up 229% since then. And so when you think about that, what's beating inflation? Bitcoin is. What's losing?